You want to invest in Nifty 50. You do a quick search. And two options pop up, a Nifty 50 index fund and a Nifty 50 ETF. Both track the same index, Nifty 50. So what's the difference? And more importantly, which one should you choose for better returns? It sounds like a simple choice, but this is where many investors get confused. Hello and welcome to our channel 5 Minute Finance by ET Money, where we discuss the basics of investing and personal finance. In today's video, we'll break down the key differences between mutual funds, index funds and exchange traded funds or ETFs, how they work, how they are priced, their costs, which one can offer higher returns and which one might be better for you. So let's start by understanding mutual funds. A mutual fund pools money from many investors and invests in a mix of assets like stocks or bonds. It's managed by a professional fund manager, so you don't have to pick individual investments. Now, there are two main investing approaches of mutual funds, active and passive. Active funds aim to beat the market. Fund managers research, time the market and select stocks to try and generate higher returns. Passive funds, on the other hand, don't try to beat the market. They aim to match its performance. They follow a fixed strategy and track an index like Nifty 50, Sensex or any other index, holding the same stocks in the same proportion. Now, since there's little active decision making involved, these funds have lower expense ratios and are more cost effective. Now, passive investing includes two main types of funds, index funds and exchange traded funds, ETFs. Both track a market index like Nifty 50 or Sensex or even global indices like Nasdaq 100 and follow a passive rule-based approach. So to sum up, both index funds and ETFs are low cost, passively managed and ideal for long-term investors. Then what is the difference between the two? Which one is a better investment option? Let's dig in. So index funds are open-ended mutual funds. That means you can invest any amount in them at any time and the mutual fund house will create new units for you based on the current NAV. So if one unit is priced at 100 rupees and you invest 10,000, you'll get 100 units of that index fund. These units are created directly by the mutual fund and are priced only once a day after the market closes. Now, in case of ETFs, the units are first created in large quantities by an authorized participant, usually a big financial institution. These units are then listed on the stock exchange where regular investors like you and me can buy and sell, just like buying a share of a company. So while in an index fund, units are created or redeemed directly by the fund based on investor demand, in case of ETF, units are created first by institutions and then traded on the market. That's the first basic difference. Now, since index funds are launched by mutual funds, you can invest directly through the mutual fund whenever you want. But for ETFs, you need a demat account. Next, let's talk about an important point. At what price can you buy a mutual fund or an ETF and what's the difference? Index funds are priced based on their net asset value or NAV. NAV is calculated by dividing the total value of all the stocks in the fund by number of units issued. This value is updated only once a day after the market closes. This means if you buy or sell an index fund on any day, the price you get is the NAV calculated at the end of that day, not the current market price. On the other hand, ETFs are traded on stock exchanges like shares, so their price fluctuates throughout the trading day based on supply and demand. Now listen to this carefully. The market price of an ETF can sometimes differ from its actual value, which is called the NAV. ETFs can trade at a discount or premium. Now, an ETF is said to be trading at a discount when its market price is lower than its NAV. So, if NAV of an ETF is 100 but it's trading at 98, it's trading at a discount, 2 rupee discount. This could happen if there's more selling pressure or less demand in the market. An ETF trades at a premium when its market price is higher than its NAV. So, if the NAV is 100 and ETF is trading at 102, it's trading at a 2 rupees premium. This often happens when there's high demand for the ETF in the market. Now, as an investor, buying at large premium means you are paying more than the actual value of the ETF. Buying at a discount may look attractive, but you should check if the discount is due to low liquidity or poor tracking. So, how can you tell if an ETF is fairly priced or if it's trading at a discount or premium? Well, that's where INAV comes into play. INAV is indicative NAV. It is a real-time estimate of an ETF's value during market hours. It helps you see if the ETF is trading at a fair price, a premium, or at discount. Take, for example, Nippon India ETF Nifty 50 BEES currently at the time of writing this script is trading at 277 per unit. Its INAV is 276.8, which means that it's fairly priced ETF. Alright, so by now you would have understood the difference between mutual funds, index funds and ETFs. It's time for the real question. If both track the same index, what is the difference in the cost and which one delivers better returns for you? ETFs and index funds have different cost structures, mainly around expense ratio and transaction costs. ETFs usually have lower expense ratios than index funds because they don't handle frequent buy-sell requests from retail investors. On the other hand, ETFs require a demat and trading account, so you'll pay brokerage taxes and face bid-ask spreads. Index funds, especially direct plans, are slightly costlier on expense ratio but have no trading costs, making them simpler and more beginner-friendly. In short, ETFs are cheaper on ongoing fees, but index funds are more hassle-free for new investors. To answer this, you need to understand a concept called tracking error. Now, both index funds and ETFs aim to copy an index like Nifty 50, right? But in reality, look at your screens. Their returns are never exactly the same as the index. This difference in the returns is called tracking error. So what causes this gap? There are fund expenses, cash held in the fund, rebalancing delays, and in the case of ETFs, demand-supply mismatches or price fluctuations. In general, ETFs tend to have lower tracking error because they mirror the index more tightly and don't keep extra cash and usually are fully invested. Whereas index funds might hold some cash for daily redemptions, which slightly affects performance. So, if you are a performance-focused investor and want the closest possible match with index returns, ETFs may have a slight edge. But remember, tracking error is just one piece of the puzzle. You still need to look at costs, convenience, taxation, and your own comfort level. So which one is better for you to invest? Well, there's no one-size-fits-all answer. If you prefer simplicity and automation, go with index funds. If you want flexibility and lower fees, ETFs might suit you better. Thanks for watching, and if you found this helpful, don't forget to like, share, and subscribe for more beginner-friendly investing content. See you in the next one.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.